All right, now, so let's head to the markets now. And today we're starting with the fixed income market. Yesterday, Nigeria had an auction, treasury bill auction. So let's look at that for a bit. What was offered yesterday was a 91-day bill worth 100 billion naira, while 182-day bill was a 50 billion dollar naira, and then for 364 it was 550. A total of 700 billion is what the government offered yesterday. Now we learned that, let's say the other slide, that total demand reached 2.41 trillion naira at the end of the day. That translates to about 3.4 times of what was offered. So it's still in very high demand. Talking about the treasury bills here in Nigeria, a bid to offer ratio of that. And then the DMO ultimately allotted 731.75 billion, implying a bid to cover ratio of 3.3 times, and stop rate fell by 5 basis points. Obviously, I mean, when there's so much demand, then the government can reduce their rates. So we saw rates fall by 5 basis points to 16.14 and 16.15 for the 182 and 364 respectively, but stayed unchanged for the shortest security right there at that's the 91 tenure. So let's talk to Akewe now and get more details of that market and the trading yesterday. Akewe, good afternoon. Welcome to the program.
Good afternoon. Thank you for having me on the program.
You're welcome. So we see that it's still a hot cake, a lot more demand than what was even supplied. And so, of course, expectedly, the rates dropped. So we are still safe when we look at our fixed income market, I guess.
Yes, you're right. So the demand, when you compare it to what was on offer, was almost three times more than what was on offer. But what is worthy of note, what you should really look at is at what rate were those bids keyed in? What was the investor appetite for the 1 year bill, where you see the focus on the subscription? The subscription was very heavy on the 1 year paper, over 2.2 trillion on that. But what we saw is that the bids were actually keyed in on at a higher level. So people are clamoring, or investors are clamoring for higher rates. So we saw the range of bids on that particular tenor between 15.5 to 20% level, even though the DMO still dropped the rates and closed it around 16.15%. We know that the appetite is for higher yields. So despite the fact that inflation is currently at 15.38%, so when you have these papers at 16.15, it actually shows that investors are getting a positive return on their investment. But notwithstanding, these investors are looking for higher yields, and that's why we saw, even where the DMO closed that auction, only 600 billion of that fell below that 16.15% that the 1 year paper closed at. So what we see in the market is market has been bearish. People are looking to buy these bonds or these bills in the secondary market around 16.1% level. So the bill is not really trading actively. Today, we've seen the CBN come into the market to issue an OMO auction today, just to try to mop up part of this liquidity that the DMO didn't take out of the system. So an OMO auction of about 600 billion was floated today. What we expect is that the rates are going to close as high as 19.97% levels, which is actually good return on investors' funds. So, and one of the reasons why banks are skeptical about buying these low yields at the NTB is because banks actually have alternatives where they can place their go to the SDF window and you can place your funds as high as 22% level. So you actually get good returns for the investment. So I don't think that investors are looking to go below the 16% levels that the auction closed at.
Yeah, I guess everybody just wants to at least cover the inflation rate. That's the least that they can get. But help us to understand. A lot of times we see that investors are most attracted to the short-term securities. Is there any implication? Is there anything we should understand from that?
Okay, so when you look at where the 90-day paper closed, 15.94, so it's still above the inflation figure, which is at 15.38. So for treasury bills, if you take short-term decisions, if there are opportunities that could yield higher return, you can actually come out from the investment. Then you can invest in other papers that are earning higher returns. So that's why we see those rates, those levels. But when you look at the auction, you can see the demand itself is skewed towards the higher, the 1 year paper, because you want to also lock in your investment long term, not knowing what's going to happen. So you just put the money. If you can get up to 20%, it means your yield will be around 23% level. So while some investors look at playing short ends on the T-bills place, the FPIs are actually particular about the 1 year paper because they've taken this for want to ensure that they lock it in for that tenor and the investment is fixed and they know what return they're going to be getting at the end of the year.
All right, Akwe, thank you so much for helping us understand that. Akwe Okutu is the chief dealer at Lotus Bank. Thank you and enjoy the rest of your day.
Thank you.